This video is for educational purposes only and is not professional financial advice. Do your own research before investing. Bloom Energy, ticker BE, a company engineering electricity from chemistry. No combustion, no grid dependency, just clean, reliable power delivered on site. The central question every investor needs to answer right now is Bloom Energy capturing a massive market opportunity, and is the market pricing that correctly? Because the revenue numbers are not subtle. This is a business that just posted 130% year-over-year growth, and the trajectory is still climbing. Over the next several minutes, we are going to break down the market opportunity, the acceleration in Bloom's growth story, how it stacks up against its closest competitors, whether the unit economics actually hold at scale, and whether today's valuation is a premium worth paying or a risk worth avoiding. The data tells a story that is hard to ignore. Let's find out if it adds up. The global demand for reliable, decentralized power is accelerating. Data centers are multiplying to serve artificial intelligence workloads. Hospitals and critical infrastructure operators cannot tolerate grid outages. Utilities are straining under electrification pressure. The electrical equipment and parts sector sits directly at the intersection of these secular tailwinds, and companies that can deliver on-site, fuel-flexible power generation are competing for a share of that rapidly expanding demand. Bloom's revenue trajectory reflects exactly that tailwind. The most recent trailing 12-month revenue came in at $751 million. But more telling is the sequential quarterly acceleration, $401 million in the second quarter of 2025, climbing to $519 million in the third quarter, surging to $778 million in the fourth quarter, and holding strong at $751 million in the first quarter of 2026. This is not lumpy, one-quarter growth. This is a compounding climb. Against sector peers, the gap is striking. EME is growing revenue at 16.6% with a gross margin of 19.6%. FIX is at 29.5% growth and 24.1% margins. HEI shows 39.8% margins, but only 16.3% revenue growth. Bloom is outpacing every peer on growth, by a wide margin. The forward question is whether this velocity is sustainable, or whether it reflects a concentrated burst that the business must now prove it can repeat. The flywheel is spinning faster. That is not a metaphor, it is what the data shows. Bloom Energy's year-over-year revenue growth has been accelerating quarter after quarter, and the most recent print is a number that stops you cold. 130.4% growth year-over-year in the first quarter of 2026. To understand how we got here, trace the trajectory. In the second quarter of 2024, growth was just 11.5%. By the third quarter of 2024, it had turned negative, down 17.5%. Then something shifted. The fourth quarter of 2024 delivered 60.4% growth. The first quarter of 2025 came in at 38.6%. The second quarter pushed to 19.5%, a brief pause, before the third quarter reignited at 57.1%. Then the fourth quarter of 2025, 35.9%. And then the first quarter of 2026 printed that 130.4% figure on $751 million in revenue. This is not continuity. This is compounding velocity. Growth is not plateauing. It is accelerating. The question the rest of this video has to answer is whether that acceleration reflects durable demand capture or a temporary surge that the business must now defend. Start with the data, because the data makes the case better than any qualitative argument. The average peer revenue growth rate across EME, FIX, and HEI is roughly 20.8%. Bloom Energy is compounding at 130.4%. That gap, more than 100 percentage points of separation, is not a rounding error. That is the moat in action. On the bar chart visible on screen, Bloom's growth column simply dwarfs the peer group. On the scatter plot, Bloom sits far to the right on the growth axis. Where it lands on the margin axis is where the story gets nuanced. EME runs a 19.6% gross margin. FIX sits at 24.1%. HEI leads the peer group at 39.8%. Bloom comes in at 29%, above two of its three peers, and meaningfully below HEI. But here is what the gross margin trend on the left panel reveals. Bloom's margins are not static. They started at 20.1% in 2021, compressed to 12.4% in 2022, recovered to 14.8% in 2023, and then expanded sharply, 27.5% in 2024 and 29% in 2025. That is a business finding its structural pricing floor and pushing higher. Growing faster than any peer while simultaneously expanding margins suggests the competitive advantage here is real, not borrowed. Gross margin tells you whether a business model is working. For Bloom Energy, the answer is increasingly yes. Starting at 20.1% in 2021, margins compressed to 12.4% in 2022, a difficult period. Recovery began in 2023 at 14.8%. Then the business inflected, 27.5% in 2024 and 29% in 2025. That is nearly doubling the gross margin in 2 years. This is not a company fighting for pricing power. It is a company building it. The Rule of 40 score confirms the picture. At 40.2, Bloom sits just above the 40-point benchmark that separates healthy growth companies from those burning capital to buy revenue. A score above 40 means the combination of growth rate and profitability margin adds up to a sustainable, balanced business. Bloom is clearing that bar. Now consider operational leverage. With 2,127 employees and trailing 12-month revenue of $751 million, Bloom is generating roughly $353,000 in revenue per employee. That is a meaningful output ratio for a company at this stage of scaling. And on valuation context, the current price-to-sales ratio is 10.3 times against a sector average of 3.6 times. The market is clearly paying a growth premium here. The question is whether the unit economics, expanding margins, a Rule of 40 score above 40, and strong revenue per employee justify that premium. That is the question the next scene addresses directly. The PS ratio history panel anchors the valuation conversation. At the end of 2021, Bloom traded at 3.9 times sales. It compressed to 3 times in 2022, then to 2.4 times in 2023, before recovering to 3.4 times in 2024. Then the market re-rated sharply, 10.3 times sales at the end of 2025. The sector median shown as the dashed reference line sits at 3.6 times. Bloom is trading at nearly 3 times that sector median, a substantial premium. The valuation meter reframes that premium. The PS to growth ratio is 0.08 times. In plain English, for every percentage point of revenue growth Bloom is delivering, the market is paying less than 1/10 of one sales multiple. A ratio below 1 times is generally considered cheap relative to growth. At 0.08, the market is pricing in almost none of the growth acceleration that the revenue growth trend chart below is showing. Quarter after quarter, that growth line has moved higher, and yet the growth-adjusted multiple remains near the floor. The gross margin trend reinforces the case. A business expanding margins from 12.4% to 29% deserves a higher multiple than a business with flat or compressing margins. And the Rule of 40 gauge, sitting at 40.2, confirms this is a combined growth and profitability profile that earns a premium valuation. The analyst revenue scenarios complete the picture. The base case for 2027 is $4.66 billion in revenue. The bull case reaches $5.13 billion. The bear case lands at $4.2 billion. At current market cap, the implied forward price to sales against the base case is 16.5 times, a premium, but one built on a growth rate that remains, for now, extraordinary. 4 risks and 4 catalysts define the investment thesis from here. Multiple compression is the most immediate risk. Bloom trades at 10.3 times sales in an environment where interest rate sensitivity can reprice growth stocks quickly. A sentiment shift or rate spike could compress the multiple without any change in fundamentals. Competition and disruption present a structural risk. The clean energy and distributed power space is attracting well-funded competitors, from traditional utilities to venture-backed hydrogen and battery storage entrants. Bloom's technology lead is real but not permanent. Customer concentration is worth watching. Critical infrastructure clients like data centers and hospitals represent high-value contracts, but if a major deployment is delayed or canceled, The revenue impact would be visible immediately given the company's current scale. Revenue execution risk is real at this growth rate. Growing at 130% year-over-year creates an extraordinarily high bar for the next 4 quarters. Any miss against that baseline will be penalized severely by the market. On the catalyst side, data center demand is a powerful tailwind. The surge in artificial intelligence infrastructure spending is driving urgent demand for reliable on-site power, exactly what Bloom sells. Hydrogen readiness is a long-term differentiator. Bloom's fuel-flexible platform can run on hydrogen, positioning it ahead of a potential hydrogen economy build-out. Margin expansion trajectory, if it continues from 29% toward 35% or beyond, would justify a higher multiple re-rating. And international expansion offers a revenue diversification catalyst that could extend the growth runway well beyond current domestic deployment rates. The verdict on Bloom Energy is strong growth buy. Here is the bull case in one sentence. A company growing revenue at 130% year-over-year, expanding gross margins toward 30%, clearing a Rule of 40 score above 40, and trading at a PS to growth ratio of just 0.08 times is not being priced for the growth it is actually delivering. Here is the bear case in one sentence. If growth decelerates sharply from this extraordinary baseline, or if interest rates reprice growth multiples sector-wide, a stock at 10.3 times sales with a 16.5 times implied forward multiple has meaningful downside. But the data, taken together, points in one direction: accelerating revenue growth, expanding margins, positive free cash flow, a valuation that looks expensive relative to the sector average, but cheap relative to the growth rate. Bloom Energy is capturing real demand from a secular infrastructure build-out, and the market has not yet fully priced what that trajectory implies. If you found this analysis useful, subscribe for more data-driven breakdowns, and check the description for the full financial data behind every number in this video.